Welcome back. Earlier today it was reported the consumer price index rose 0.1% versus a prior month of 0.4%, a little bit less than the prior month. The core CPI, excluding food and energy, rose 0.4 versus a prior month 0.5. Again, a little bit of a decline, or a smaller report, I should say. CPI year over year 5.0 versus 6.0, another decline. Core CPI year over year 5.6 versus 5.5. The only real increase in the CPI is on a year over year basis, and that's core CPI, excluding food and energy. And we can see here exactly why this is the case. The blue histogram bars show us a standard CPI report. The black dotted line is core CPI. The green line is the food, and the red line is CPI energy. And after hitting a very significant high, June of last year, we've seen nothing but declines for inflation in respect to energy prices. If you take out energy, CPI appears to be a lot stronger, in housing numbers, for example, things of that nature. But energy is significantly declining. Now, we take a look at the histogram bars. The blue represents CPI. The orange histogram bars show us core CPI. Again, core CPI excludes food and energy. And notice how the divergence between the two, the orange line is a lot further higher than the blue line is most recently, as opposed to earlier on. In fact, if we go back to June of last year, CPI, including food and energy, was actually higher than the core CPI. Food prices remain constant, a little bit of an uptick, but constant. It's really the energy prices which are declining. We compare here CPI in red to the core CPI, again excluding food and energy. Notice how there was a very significant divergence, but because of falling energy prices, these two lines have all but merged. We can compare CPI to PPI. PPI is Producer Price Index, and it's thought that as the PPI, the green line, increases, so will CPI. We saw a very big run up in the PPI, and not so far yet in the CPI. The red line shows us the relationship between the two. So when the red line was declining, it showed us that the manufacturing prices, the prices to the manufacturers, the PPI, that was rising. But so far, this has not reversed course. And then finally, we take a look at what the markets look like in the 1980s. I like to go back to this because I think it's very relevant. The last time we saw such a tremendous amount of inflation in a relatively short amount of time. Now, the blue histogram bars show us the overall CPI. The red line is CPI energy. And notice what happened. December 1985. Now, obviously, we know those very troublesome stock markets in 1987. This is far before that, but energy prices really declined. Now, I don't know if there's a correlation between the two, but I find, the coincidence to be quite interesting. Now, I think it's important to look at the bond markets because, again, we look at these individual economic numbers ultimately to try to understand what the Federal Reserve is most likely to do in the future. Are they going to continue to raise interest rates? Are they going to start to cool on interest rates? And CPI, the inflation numbers, are a very big part of that. So these are where the current U.S. Treasury stand. And the Treasury market, the U.S. bond market, really does give us an insight as far as where the Federal Reserve is looking. The 10-year bonds at 3.38%. That's the lowest in our spectrum. The 5-year to 345. The 1 year is at 457. So we see over 100 and let's say almost 20 basis points inverted bond market still very much in play. The highest yield is on the 3-month, and we've spoken about this during other discussions we have about the inverted bond markets. We saw in the past the highest yield was offered on the 12-month. But now we've seen the highest yield has moved to the 6-month and now the 3-month. One idea, the reason why this is happening is because a bond market tells us Essentially, when the bond market believes, and the bond market is all of us, it's macroeconomic forecasts, it tells us when we believe the Federal Reserve will cease their interest rate tightening cycle. Meaning when they're going to stop raising interest rates. Now, when we were, 6 months out, or maybe a year ago, we saw the highest yield was on a 12-month. The bond market loosely was telling us, okay, maybe a year out. Well, I don't know exactly, but it was telling us far out into the future. The Federal Reserve will stop raising interest rates. As we get closer to the inevitable that the bond market that the Federal Reserve will stop raising interest rates, we see the highest yield emerge on the shortest term maturities. As we see higher yields move from the 12-month to the 6 and now the 3, it tells us that we're getting closer and closer to that date that the Federal Reserve is going to stop raising interest rates. And eventually, we may get to the point where the bond market says, hey, the Federal Reserve is going to cut interest rates. And if and when that happens, then we'll see the shortest term maturity start to collapse. This is the 1-month change in the bond market. We see the biggest move up are the 3-month bonds. Those yields, I should say, are up 6%. The biggest move to the downside are the 3 years. So we see the capital is moving into the longer term, or I should say it's moving out of the short term. That when we see yields go up, it means that traders are selling the short-term bonds, and bond prices go down, the yields go up. This is that was a 1-month change in the treasuries. This is what we're looking at now in terms of the position of the Treasury market. The blue histogram bars, by the way, represent the S&P 500. One big change we've seen, let's see here, the green line, that's a 1-month bond. Yields really coming down. We haven't seen that in prior circumstances, but we see really the very short-term yields are starting to come down. Does this forecast that the 3-month and the 6-month will start to move down? Does this forecast that maybe the Federal Reserve is done tightening and that maybe they're going to start to cut interest rates? I think maybe it's too early to say that, but it's very interesting to see how all of a sudden the 1 month, I should say, has really found a little bit of weakness. That's not the case with any of the other bonds. The 3-month, the purple line over here, staying constant, right around the 5% level. We can compare now let's see here, the 10-year let's take a look first of all, the 10-year versus the 1 year in the year 2000. The red line is the 1 year, the black line is a 10-year. We had an inverted bond market. That's when the red line was above the black line. The histogram bars show us, by the way, the inversion. That was inverted at this point. All of a sudden, the beginning of 2001, the 1 year started to collapse. Remember, when we start to see the very short-term yields, like the 1 month, or in this case, the 1 year collapse, this tells us the bond market's forecasting maybe the Federal Reserve is going to start to lower interest rates. Well, if you remember, late 2000, early 2001, we had very high interest rates, around 5%. And this was the bond market telling us maybe that's going to change. Fast forward to present day, the 10 versus the 1. The 10 is a black line. The red is a 1 line. We're still in an inverted situation. We're not yet seeing the 1 year cross back below. Now, we also compare the 10 to the 2 year and the same chart as well. We have very much inverted bond market. So I think the bond market may be in part due to the inflation numbers today that were, very much due to weakening energy prices weak. Maybe that's telling us that the bond market is predicting the end of the interest rate hikes, but not yet the beginning of a real cooling period where they may start to cut interest rates. We're too early for that. If and when that time comes, then we're going to start to see the short-term bonds, first the 1 month and the 3, then maybe the 6 month and the 1 year. We'll start to see those yields go down. So we're not there yet. But I think that the bond market is telling us we're close to the end of the interest rate hikes. And today's inflation number certainly does back that up. We hope this has been helpful. We look forward to seeing you back soon.